Thanks for tuning in for the latest stock news updates on Tesla, Mullen, and Lucid. For more EV stock updates, press the like button and subscribe. With that being said, let's jump right into the video. Shares of electric vehicle leader Tesla have endured a tumultuous period over the past few weeks, grappling with a blend of internal company dynamics and broader market fluctuations. As of late, these challenges have converged to place additional pressure on the company's stock, causing a series of consecutive declines. Tesla's stock saw a decline of 1.7% to $215.49, in stark contrast to the relatively stable performance of the broader market indices. This marked the sixth successive drop for Tesla's stock, with 13 losses out of the past 14 trading sessions. Part of the blame for these losses can be attributed to the overall market sentiment. The NASDAQ composite, which Tesla is listed on, had already experienced a decline of approximately 7% for the month. The company's stock is known for its heightened volatility compared to the broader market, experiencing rapid growth during favorable conditions and significant declines during downturns. Elon Musk, Tesla's high-profile CEO, has played a role in exacerbating concerns among investors. During the company's second quarter earnings conference call in July, Musk reiterated his belief that sales volume growth took precedence over pricing considerations for Tesla. After implementing aggressive price reductions at the beginning of 2023, Tesla reported a decline in operating profit margins during the first half of the year, dropping from approximately 17% in the same period of 2022 to just over 10%. This reinforced skepticism about the long-term sustainability of Tesla's business model, particularly as the company continues to prioritize sales volume expansion. The impact of Musk's statements on Tesla's valuation and market performance has not gone unnoticed. Tesla's stock has plunged by roughly 25% since his comments. In comparison, other major technology stocks have experienced an average decline of around 3% over the same time frame. Likewise, traditional automotive manufacturers such as General Motors, Ford Motor, and Stellantis have suffered average losses of approximately 12%. Despite the challenging circumstances, some analysts see potential silver linings. Tesla's stock appears to be approaching a zone of technical support. According to technical stock market analyst and Cap Thesis founder Frank Capillari, after breaching the $240 per share mark, the area between the February and March highs could serve as the next potential stopping point, ranging from $208 to $218 per share. This is corroborated by Fairlead Strategies founder and market technician Katie Stockton, who suggests that the 200-day moving average, currently near $197 and gradually rising, adds additional support to the $200 level based on a 50% retracement of the year-to-date uptrend. Technical analysis aside, the critical question is how Tesla will address its current challenges. There are indications that the company may be exploring collaborations and strategies to counteract the negative impact. On top of that, Honda, a prominent player in the automotive industry, has confirmed its intention to adopt the new American charging standard, which is a charging connector designed by Tesla. This move appears to be driven by General Motors' adoption of the same charging standard and Honda's reliance on GM's electric vehicle platform in North America. This adoption is significant for Tesla, as it could lead to expanded use of Tesla's Supercharger network and adapters by other manufacturers. Jay Joseph, American Honda's Vice President of Sustainability and Business Development, lauded Tesla's Supercharger network for its effective maintenance practices, praising their proactive approach to equipment monitoring and swift issue resolution. Furthermore, Honda's decision to partner with other major automakers in building a new EV charging network in North America signifies a broader industry trend toward collaborative efforts to accelerate the adoption of electric vehicles. Now let's talk about Mullen Automotive, which is a budding player in the electric vehicle sector, finds itself on the brink of significant financial turmoil. As of March 31st, the company boasted approximately $235 million in liquidity, a seemingly substantial figure. However, scrutinizing its current cash burn rate and the absence of revenue, projections suggest that Mullen could exhaust its funds as early as the first quarter of 2024. Moreover, the company faces hurdles in raising additional capital, potentially leading to delisting concerns due to its stock price hovering below the $1 mark. While the company currently holds manageable debt of around $7 million maturing over the next year, the primary concern lies in its cash burn rate. With an expenditure of $34 million in Q2 and nearly $70 million in the first half of the fiscal year, despite increasing liquidity to $235 million, Mullen's aggressive cash burn rate raises questions about its long-term sustainability. Despite recently announcing deals valued at around $80 million, the expected ramp-up in production to fulfill these contracts will likely lead to elevated operating costs. This has prompted skepticism about whether the current liquidity cushion can sustain the company's operations over an extended period. Mullen's stock price hovers just below the $1 mark, a precarious position that complicates its capital-raising efforts. Considering the company's history of reverse splits this year, further dilution of shares could lead to the risk of delisting. Under NASDAQ listing requirements, a cumulative reverse split ratio exceeding 250 to 1 coupled with a bid price below $1 could trigger a delisting determination. Thus, Mullen faces the challenge of maintaining a trading price above $1 without resorting to reverse splits, a daunting task given the imperative need for additional capital. In the absence of favorable developments, Mullen faces two primary potential outcomes. The first involves raising capital through share dilution and subsequent delisting from NASDAQ. The second, more dire outcome could entail seeking relief under Chapter 11 bankruptcy. Both scenarios pose significant risks to the company's future prospects. Although the probability of Mullen depleting its cash reserves appears high, several upside risks could challenge this thesis. If the company demonstrates strong delivery and production numbers, it may sustain a stock price above $1, facilitating future capital raising. Additionally, if Mullen's management projections regarding its liquidity and financial needs prove accurate, the company might navigate the challenging landscape successfully. Mullen Automotive's financial struggles are rooted in its cash burn rate, potential production challenges, and the conundrum of raising capital without adversely affecting its stock price. As the company treads a precarious path forward, the challenges it faces in maintaining financial stability and securing its future growth are considerable. As such, a sell rating seems prudent in light of the uncertainties surrounding the company's financial health and long-term viability. Lastly, we have Lucid Group, an emerging player in the electric vehicle sector, has experienced a dynamic quarter in terms of institutional ownership. The recently passed deadline for institutional investors to file a Form 13F has unveiled a range of insights into Lucid's institutional landscape, reflecting both increased ownership and potential challenges the company faces. As of the second quarter, a total of 456 13F filers have disclosed their stake in LCID stock, marking an increase of 9 filers from the previous quarter. Impressively, institutional investors have bolstered their ownership of Lucid by holding 1.66 billion shares, up from the previous quarter's 1.31 billion shares. Of the institutional filers, one entity stands out as a top holder of Lucid stock, IR Third Investment Company, a subsidiary of Saudi Arabia's public investment fund. This institution is a key player in Lucid's ownership landscape, asserting itself as the most prominent shareholder with approximately 1.3 billion shares. Also, Vanguard, a prominent exchange-traded fund provider, emerged as a notable purchaser of Lucid during the second quarter. Its acquisition of 15.03 million shares elevated its total stake to 73.16 million shares. This notable expansion of ownership secured Vanguard's position as the second largest shareholder. We also saw BlackRock, a major asset management firm, also displayed significant interest in Lucid by adding 10.99 million shares to its existing holdings during the quarter. This brought BlackRock's total ownership to 45.33 million shares. Furthermore, Bank of America joined the ranks of institutional investors acquiring Lucid shares, increasing its position by 14.8 million shares, culminating in a total holding of 17.21 million shares. Lucid's trajectory on the stock market has been marked by both soaring highs and significant downturns. After reaching the $50 range subsequent to its special purpose acquisition company deal, the company's stock price has plummeted below $7. This decline can be attributed to the company's struggle in scaling up production to meet demand and contend with competitors. In terms of performance, Lucid reported delivering 1,404 vehicles during Q2, compared to the prior year's 679 vehicles. Its production numbers also saw an uptick, with 2,173 vehicles produced during the quarter. Despite this growth, the company fell short of analyst estimates, reporting quarterly revenue of $150.9 million against an anticipated $175 million. While the company faces challenges, Wall Street analysts remain cautiously optimistic, envisioning a potential price increase in the next 12 months. Analyst consensus data on Refinitiv reflects a hold rating for Lucid stock based on input from 13 analysts over the past 3 months. The average price target projected is $8.20, indicating a potential gain of 32% from the current trading price of $6.20. Lucid Group's recent institutional ownership trends provide valuable insights into the company's market perception and financial standing. The influx of institutional investors reflects both interest in the company's potential and the challenges it faces in the EV sector. As Lucid grapples with production scaling and market competition, its future prospects remain a subject of considerable speculation, with analyst sentiment oscillating between caution and optimism. And that concludes the video. For more videos on the latest stock market news, press the like button and subscribe. With that being said, I wish you happy investing.